This is going to be mind-blowing news. It's not necessarily new, but it's something that is not being talked about enough. And it's mainly going to affect dealerships and manufacturers, but whatever affects manufacturers and dealerships actually trickles down to the consumer. So hear me out on this. Welcome to HBRV Lifestyle. I'm John Levingston, aka the Honey Badger, and as some of you might know me as the Blowhard, here to give it to you straight and transparent about the RV business, as well as some other things. So this podcast episode I'm doing live because what I have to say is going to have a lot of so's and ats and does, and there's going to be some interaction of repeating myself, and it's hard to do that when I record, a regular video. Banks, financial institutions are beginning the process, and some of them are already in the middle of process of pulling back out of industries. Hello, Seeking Truth. Hi, Steve. Thanks. Well, it's not my birthday. My birthday was in July, but thank you. Number one, when I talk about they're pulling out of industry, they're pulling out of basically lending on inventory. So we're starting to see lenders pull out of places that sell retail goods. It's not just RVs. It's also cars, boats, TVs, electronics. The only thing really being stuck and not being affected is stuff we use on an everyday basis, like toothpaste, toothbrush, paper towels, toilet paper, food, etc. Okay. What we are seeing right now, and specifically in the RV industry, is we are seeing floor plan banks, so inventory loan banks, are starting to pull out of the RV industry. They're also pulling out of the car industry and the boat industry. And the biggest reason why they're doing that, in their opinion, is because they're taking too many losses. So even though interest rates are up, they're not making the money they need to in order for that type of loan to be profitable. For that type of loan to be profitable, inventory has to turn at a regular rate. When you have too much imbalance of inventory, and what I mean by that is you have some dealers across the United States and Canada that are overfilled with inventory. And then you have the other part of the country that's or the other part of the industry that's very low on inventory and focusing solely on used, or they're focusing on 25% new, 75% used. So you have these banks are looking at these large corporations, these bigger dealerships, and what they're doing is they are looking and going, well, they're trying to negotiate their interest rate payments and their curtailment payments. And if you don't know what curtailment is, a curtailment's a simple thing. It's paying down the principal of the loan. It's a separate payment that's made to pay down the principal of the actual piece of inventory. Retail, they're still going to do retail loans, Seeking Truth. It's not about you going and purchasing. It's about the dealership being able to purchase from the manufacturer. Okay, so if you go to the Camping World, you go to Blue Compass, you go to Mom and Pop, you could still get a loan with the same banks. What they're doing is they're looking at allocation of funds. So retail is always going to be there. They're going to fund cars, they're going to fund boats, they're going to fund RVs, they're going to fund TVs, they're going to fund lifestyle. They're still going to retail do that. But inventory loans are different. Okay. There are lending institutions that are solely for the RV industry, solely for the boat industry and the car industry, but I'm talking about big banks. US Bank, Wells Fargo, Chase, Manhattan, Bank of America, or sorry, JPMorgan Chase, Bank of America. These are companies that are slowly pulling out of the wholesale game of different industries.